asset class on that. Any questions, colleagues? Please take a 15-minute break. I would be taking a 2-minute break. Any questions, please ask me. 15 minutes, we'll start. I like to start with what is known as free cash flow, right? What is known as free, thank you, right? What is known as free cash flow method? Ask me if I don't communicate. Absolutely important is what is free cash flow method. Extremely important. I repeat one line which I had said, Sanjay sir. Goodwill, because you're very keen on financial statements. Goodwill on anybody's balance sheet is not their goodwill. It is the goodwill of anything that they have acquired, okay, and paid over and above the balance sheet value. Having said that, what is the FCFF? What we are going to do today is a very simple mechanism and very logical to understand this valuation. FCFF, which basically means, Vishwanath sir, it basically means free cash flow to firm, Sushil sir. Free cash flow to firm. So please get this right. I'm starting with a basic thing which is known as discounted cash flow. I am defining what is known as, right, free cash flow to firm. A firm means it is made up of two things. Now let me explain this, right, and take you all through it. I'm going to share that model to you all. I'll give you my email ID, right. If you've got a pen drive, take it straight away. If not, right, mail me, I'll give it to you, right, because that's a working model that I've done for the workshop. Please understand, any firm, how does it basically, come across and derive its value? Two things. One, it will get its value from debt. How does it source? In fact, sir has already said that. How does it source that money? From debt and equity. That means your free cash flow should capture some item which can be used to service both debt and equity. That profit and loss that you have drawn should capture that item that you select from that profit and loss should be able to service both debt and equity. So please note, and that's exactly where what we start from in free cash flow to firm is what is known as, thank you, earnings before interest and tax. Earnings before interest and tax, because this, sir, thank you, Prasanna sir, includes interest which can be used to service debt and also the earnings which can be used to service equity. But then, as you would very quickly notice, Vishwanath sir, it has got a component, right? It has got a component which is a leakage from the firm, which the firm has to pay, which is tax. So here you would say EBIT minus tax. I think we had a good discussion. Please note, tax, as Sanjay sir very correctly pointed out, would be effective tax. Tax would be effective tax. This EBIT minus tax, sir, this is for you all. Sir, this is for you. Globally is also known as NOPAT, net operating profit adjusted for tax. So if you look at somebody's valuation, and right, as my colleague very correctly said, I'm so happy you're very clear in what you wanted. Oh, if I look at somebody's report and I want to see the jargon, if somebody says NOPAT, it means net operating profit adjusted for tax. So what has been done is EBIT minus tax. Sushil sir, if you are, Vishwanath sir, more specifically, if you are dealing with an European client, they will call it as NOPLAT. Same thing, right? Net operating profit less adjusted tax. So both are the same, right? Please, jargons are extremely simple. What it means is EBIT minus tax. Indian jargon is NOPAT. So when you did your AMP, they would have called it as NOPAT. Very, very clearly NOPAT. Now, to arrive at EBIT minus tax, right, to arrive at EBIT, you removed something which was a non-cash expenditure. And I am not asking you all, it's a very evolved audience. What you removed, right, to arrive at EBIT is, as Mr. Saraf would tell us, is depreciation and amortization. So you'll add it back because we are doing free cash flow. The entire thing is to understand what is the cash on hand. So yes, we removed loss of value. Esteemed colleague said that. Loss of value. You said loss of value, but when you said loss of value, you said there's been a loss of value of 20 crores because of depreciation. You don't pay anybody that amount. That amount is with you. You are only reducing the value of your asset by that extent. Add it back. Just add it back because, sir, you are talking about cash in hand. And cash in hand is these two. Now what? Now what? Vishwas sir, let me interact with you. Pleasure having you here. What does your firm do with the cash available?
We reinvest the 80%, 70 to 80%.
Sir, I don't want numbers. I want the way you communicate only on strategy level. I don't want any proprietary things. But you said something. I'm so happy. What do you do? Majority, what do you do?
See, in our business, majority is held as cash reserves.
Okay.
Because there is no huge capex involved at all. I mean,
okay.
Until unless you want to expand your facility, you're going for a land or a lease kind of, or you're setting up an infrastructure kind of. But most of the cash that we have, A is service for salaries, 70% of the cost go for salaries in our business, as you mentioned. And B is in our line of business, especially for engineering. I think even Sanjay would agree,
Mr. Pillai, yeah.
Pillai would agree that our licensing, our assets which enable the business are more expensive than IT or outsourcing. So apples versus apples does not work when we do for an IT company because most of them are cloud or very cheap, are open source. But in our line of business, so most of it is actually the cash flow that you're talking about. The cash that is got is actually reinvested on licenses and the labor. So.
Thank you. What do you do, Sushil sir, before I come in and give you the next? Look for a new idea. And then do what, sir? With the available cash? So you look for new ideas. And then what do you do, sir? Suppose you get a new idea,
I don't have much idea on
you don't have much idea. I heard you look for a new idea to invest. I'm sorry. Very sorry, sir. Very sorry. I didn't understand. Sanjay, sir? A dear colleague, sorry again, a dear colleague says, I'll acquire licenses. Another dear colleague says, all right, I increase the asset base. The next thing in free cash flow to firm is minus capex. Capex need not be only in hard assets. Capex can also be in new licenses. Incidentally, sir, one sec. Incidentally, always welcome. Please note, it's about growth. Capex gives you growth. So in your case, maybe, I do not know. You will speak, I'll listen to you. You will say, I'll start another location. Or you may decide, for all that you know, you are a better judge, you will say, in the same location, I'll possibly take franchisee of somebody else, and that part, I will use it for that. Please understand, it is this part which has to be subtracted, because this is your investment for the future. And before I request Prasanna sir to come into his noting, the last heading is, whenever capex increases, excuse me, I repeat, capex need not be in hard assets. It could be in licenses. It could be an innovation also. But there is a capex involved which will drain you out of the cash. And can I just say this very clearly? In SME sector, what drains these people purely out of cash is capex decisions. जब तक operation है वो चलता रहता है, जैसे ही expand करते हैं, right? They are not able to manage. For example, a very clear-cut case, and there's this gentleman in Hyderabad, cotton ginning, and cotton, I'm sure you understand, is a seasonal product. So what happened is he decided to get into manufacturing, and he set up a capacity for manufacturing, and that entire thing got delayed. That capex decision actually hit back his entire operations. Minus capex, can somebody finish it for me? And I think Mr. Ganesh will definitely finish it for me because of capex decision. And then I want Prasanna sir to come in. Because of capex, there is one additional requirement which comes up. Because of capex. I don't want to ask Pillai sir or Sanjay sir. You would. I think I am not communicating. I'm sorry. Okay, I have. You are very good. I have 5 machines, sir. Now I have increased capacity by 2. So I have 2 additional machines. Capex kar diya 2 machine mein. Because of that, some requirements have gone up. No, sir. What is that? I'm asking you because you said it. Thank you. आपने ही बोला था, right? Minus 1 second, sir. Minus, my formula is through. I want to start with Prasanna sir. Minus, my formula is through. Minus, Vishwanath sir. It is, Sushil sir, it is incremental working capital requirements. It is incremental working capital requirements. So because of that expansion, Sanjay sir, earlier I was able to run this restaurant with a working capital of 30 crores. Now I need 35 crores. That 5 crores should come here. Incremental working capital. Sanjay sir, here is it. That's your formula for free cash flow, right? Free cash flow to firm. I'm open for questions, starting with Prasanna sir. Thank you for your patience, sir. First is NOPAT. Vishwanath sir, this entire thing I'm saying NOPAT, Saraf sir. Plus DNA, minus capex, minus incremental working capital. What you now have is the starting base for projections, what is known as free cash flow to firm. Fundamental thing in DCF that we consultants use, and we will always use for any type of firm, is what is known as free cash flow to firm. And this is the beginning of, I'll be as loud as possible, sorry my voice cracks sometimes, is the fundamental thing in discounted cash flow mechanism. 4 things: NOPAT, DNA, capex, incremental working capital. Let me, sir, thanks for your patience, sir. You were saying something.
What about repayment of principal?
I wanted you to speak, sir. Sir, we will not capture repayment of principal. Why would you not capture? I knew you would ask something like this. Because, sir, we are talking of free cash flow to firm. But suppose you get suppose you get a report, right, and somebody reports to you and says free cash flow to equity, then you have to take that into account, sir. Can I suggest something, and you should tell your juniors, right, Pillai sir, you should tell your colleagues, please accept this from somebody who's put his life, professional life in the field of valuation. It makes a lot of immense sense to start with free cash flow to firm, because then you understand enterprise value, and then to remove the value of debt, and then to come at value of equity. But always makes sense, because whenever you talk to bankers, when you sit at forums, you talk to CI or TI or anywhere, we always talk in terms of EV. EV stands for enterprise value. So if you are having a system where they actually say, my request is just, it does not require a great tweak, a small tweak is to talk in terms of free cash flow to firm. So thank you for your question. If you are talking of free cash flow to equity, then you will bring all that, right? Ek minute, sir. You will say, you will talk about prepayment, new loans taken. Yahan pe to, you are talking of free cash flow to firm. So it's at the firm level. Thank you again. Ganesh ji?
I just wanted to know more about incremental working capital. In many occasions it gets added up, actually it gets deducted. So,
coming from you, I was sure. Normally, it should be added up.
Normally it should be added up, but we have an extra sign there.
Why should it be? No. You didn't understand. I'm sorry, I didn't communicate. Normally, working capital requirements increases. When I said added up, I meant increases with expansion. That's the base thing in business. Base thing in business, ki working capital requirements get increases.
Certain occasions when it's not, it decreases.
Now, can I say that exceptional case first? So 90% of the time, it will increase only. And this sign is always minus only. always minus, because that is the money which is drained out by working capital requirements. Your question specifically, dear friend, is on that 10%. Thank you for the question again. When you are acquiring a company and because of your synergy benefits, Sanjay said the fundamental principle is value the company from the buyer's perspective. I said that right at the beginning, I am repeating it. Value the company from the buyer's perspective. If you are able to look at it and say the buyer will actually reduce working capital requirements. You see, what is happening is, let me explain this. Sushil sir, right, okay, Anil Menon is running a company, and when he is running the company, the unfortunate part is, right, suppliers are not willing to give him credit. Customers are saying you will pay after 2 months. But moment Sushil sir takes over the unit, same unit, and with the change of management, what Mr. Sushil is able to negotiate is, he is able to negotiate with the raw material suppliers and say he is able to take credit of 2 months from them, same business, and the customers is able to get the money out in 15 days. Now in this case, because of this change in management, working capital requirements have decreased. In such exceptional cases, you will see minus of minus, which will become plus. But the formula remains as minus. This, Ganeshji, if further questions always welcome, is what we call as in M&A valuation. There are two types of valuation. One is standalone. Second is M&A valuation, which is where you will bring in what is known as, thank you, synergy benefits. This is what is known as synergy.